Hello, traders, and welcome to another episode. And in this episode, we are going to look at the ICT breaker blocks, and I'll be showing you how to profitably trade the ICT breaker blocks, or how to identify high probability ICT breaker blocks. The disclaimer always is that trading leverage products carries risk. The reason why we are giving you this investment or this skill so that you can be able to trade by yourself, all right, or so that you can be able to improve your trading journey. So when you talk about the ICT breaker block, so these are trading concept by the inner circle trader. Like I've always said, this is not my concept. What I'm doing, I'm just trying to simplify the concept for you guys to be able to understand. So trading ICT breaker blocks effectively involves you having a deep understanding of price action, market structure shifts, and liquidity dynamics. So here we are talking about breaker blocks being very powerful tools for identifying market reversals and continuation. So in this video, I'll be showing you, or I'll be offering you a detailed guide on how to identify and trade ICT breaker blocks like a pro, right? So let's get started. So the first thing that you need to understand is you need to be aware of what is an ICT order block, all right, or what is an ICT breaker block. For this case, you're talking about the breaker block. So a breaker block is a specific price level where previous support or resistance zone fails to hold and price breaks through. Or put in another way, we can say that a breaker block is the order block that created a higher high or a lower low before it breaks the recent swing point that was created. All right. So what I'm talking about is that we might have, or we have two types. So we have the bullish breaker block and we have the bearish breaker block. So in terms of trying to understand the breaker block, or in terms of trying to identify the breaker blocks from the charts, there are three things that we consider. So we are talking about, number one, the market structure. So there has to be a market structure break. The order blocks, there has to be order blocks and liquidity sweeps, and also there has to be key levels. So what am I talking? In terms of market structure break, you need to identify a shift in market structure. So in a downtrend, this could be a lower high that fails to hold, creating a bullish breaker block. In an uptrend, it could be a higher low that fails, therefore forming a bearish breaker block. All right. So I'm going to show you, when you go to the charts, I'm really going to show you very nicely so that you can be able to understand. Then there has to be order blocks and liquidity sweep. So in terms of order blocks, so when you go into the charts, go and look for order blocks near liquidity zones that fail to hold the prices. For example, if price sweeps liquidity below a previous low, but then quickly reverses upwards, it creates a bullish breaker block. All right. So then in terms of key levels, breaker blocks often form near important points like points of support and resistance levels, or maybe Fibonacci retracement zones, which helps in terms of adding the confluence to the setup. So the next thing, so this is what you're talking about now. As you can see in this market, the market was trying to push higher. So we had the liquidity sweep here, or maybe it can be a liquidity sweep or it can be a BOS, right? And then now what we anticipate is if the price comes back to this last sell candle before this move, which is the order block, we anticipate this to be a bullish order block to hold the prices, and we anticipate to look for buys here. But now, when the price goes below the order block and goes below the previous swing low, which is this low here, then what we want to see is now a retest. So this now order block turns to become a bearish breaker block. So in terms of order block, realize that this was a bullish order block. So we anticipated to buy from this region, but the price went straight and broke below the order block and closing below this swing low. So what we need to do now, we wait for the retest of the same. So a bullish order block that has failed will be a bearish breaker block. So we wait for the retest, as you can see here, and then now we take the trade for a sell. In identifying a bullish breaker block, as you can see here, we have the sell side liquidities being taken, or we have what we can say we also have a BOS. We can call it a BOS. That is a break of structure. And then, so as the price comes back here, remember our work is to identify the order block. And we said the order block is the last buy candle. The order block here is the last buy candle before the push on the downside, before this push on the downside. So once that happens now, we wait for the price. So in terms of order block, this will be a bearish order block. So we will be looking to sell here, as I hinted in the video, or as I showed you in the previous video about the order blocks. But now the price comes vigorously and breaks above the bearish order block. So once it breaks above the bearish order block, that bearish order block turns to be a bullish breaker block. And therefore, we will be waiting for the price to come and retest that order block, now becoming a bullish breaker block, and then now we take a buy. So what you need to understand is that a bearish order block, if it is not respected, it becomes a bullish breaker block. And a bullish order block, if it is not respected, it becomes a bearish breaker block. All right, so very simple, very simple. So what is the entry criteria? So number one, the key thing is for you to wait for price to return to the breaker block. So we are talking about a retracement. So wait for the retracement to the breaker block, and this could happen either quickly after some initial break, or it might take time depending on the market conditions or depending on the volatility of the market. And therefore, what you need to do is to avoid rushing the entries. All right, what you need to do is to avoid rushing to take the entries. So in an uptrend, so I'm just trying to illustrate what I'm talking about. All right, so here we have the price create a BOS, right, around this particular point, or we have a break of structure, or BMS, break of market structure, whichever you call it. So this is a BOS. Then now we anticipate the last sell candle here. That is where we have our order block, all right? That is where we have our bullish order block, because we anticipate the price to come to this level, and then now we anticipate to look for some buys. But now when the price does not buy and breaks below that order block, of course breaking below this low here, then what we want to see is the price come back to this order block, and this now turns to be what you are calling a bearish breaker block, and we'll be looking for sells, all right, from this particular level. So after the breakout here, we have to wait for this retracement, and then the price has to come and retest this level. So the reason why we are saying don't rush your entries, all right? Don't rush your entries, okay? So then the other key thing that you need to consider, we are talking about, or maybe probably giving you a more precise example. So as you can see here, we have the sweep of liquidities. Then we have the price come back to this level. This is where we have the order block. So this, well, now I'm trying to show you the bearish breaker block. So this is where we have the order block. So the key thing is to identify the order block. So once the order block is violated, we wait for this retest or the retracement here. So sometimes, as we have said, it can be, the retracement can happen immediately or quickly, or sometimes it can take time before the price revisits that zone. So the reason why it is always good to wait for the price, not to rush your entries, right? And this is now the kind of setup that you have. You sell here, of course, targeting these intermediate liquidities and also targeting the liquidities around this particular point. So you know how we put our take profits. You can use the risk to reward ratio of 1:2 or more, or maybe probably you can use the liquidity zones or the liquidity levels in terms of targeting your profits. So this is a bullish order block. So we have the BMS here. So then if the BMS happens, then we come and look, identify where we have the order block. So this is where we have the bearish order block. So what we anticipate is the price to come here and sell, but if price breaks above that order block and above this swing high, then we have to wait for the retracement. So you can see in this case, the retracement did not happen immediately. It had to take some time for it to come back to this particular point. And the moment the price taps into that level, you can take the trade, right? And apart from having a bearish breaker block, also around this level, we have a fair value gap, right? But I'll be doing a video about fair value gaps so that you can be able to tell which fair value gaps are of high probability and which fair value gaps are not of high probability. Okay, so then the key thing is to confirm your entry. After that, confirm your entry with price action signals. So here we are talking about maybe whether it is bullish or bearish or rejection. So look for rejection candlesticks, all right? You can look for rejection candlesticks, and this is the conservative way of trading. So look for rejection candlesticks, like maybe the pin bars or the engulfing patterns at the breaker block, indicating that price is respecting the level, right? That is the conservative way. But the aggressive way of trading is to wait, right? The moment immediately the price touches this level, you can buy. Or maybe the moment the price touches this level, you can sell. That is for a bearish breaker block. But the conservative way, we are saying that you wait for rejection candlesticks. Like here, you can see this is a pin bar, all right? So these are rejection candlesticks, meaning that your entry could be slightly below the order block. I mean, your entry could be slightly below the bearish breaker block because you have to wait to confirm rejection of prices, right? Then we are talking about market structure shifts on lower time frames. So you can use lower time frames to observe market structure shift within the bearish or within the bearish or bullish breaker block. So for instance, if trading a bullish breaker block, look for higher highs, look for higher lows forming within the block as price resets itself. So then you can look for liquidity sweeps. Often price will sweep liquidity just above or below the breaker block before making a move. This is common around stop hunt zones and strengthens the entry if a rejection occurs afterwards. So this concept of liquidity is very significant as well because it's also an ICT concept. And I remember I did a video about liquidity. Maybe you can check it. The video about liquidity, you can just go and check it, and you'll be able to understand how these liquidity points works. Then now, after you confirm your entry, of course, you have executed your trade. So you want to set your stop loss and you want to set your take profit levels, right? So using breaker blocks effectively requires disciplined risk management. Not only breaker blocks, but every strategy that you use requires disciplined risk management. So despite you having the confidence that the price gonna go your direction, sometimes it doesn't happen that way, right? So sometimes maybe the market condition can change and the trade can go against you. So the reason why you need to use stop loss. So define your stop loss and take profit strategy based on logical levels and price behaviors. So for stop loss, it's always advised to place your stop loss just beyond the breaker block or below a recent swing low or swing high, allowing a bit of room for price fluctuations. In terms of take profit, aim for recent structural highs and lows, or maybe supports and resistance levels as your first take profit targets. Also, you can use Fibonacci extensions, or liquidity pools for further profit targets. So consider taking partial profit at key levels to lock in gains and let the remainder of the position run. So taking partials is very, very important, right? Taking partials is very, very key. Then you need to some things you can factor in terms of volume and time. So the trading session is very, very important. So that is time. We are looking at the trading sessions. So trade breaker blocks during high liquidity times, such as London or New York sessions. Or maybe probably you can use the kill zones, the ICT kill zones. I also did a video about the ICT kill zones, which is named time and price theory. I really discussed about the kill zones there. So you can just revisit the video and watch that video, and you'll be able to understand about price and time theory, because it is very important when you're trading ICT. Time and price, they are very, very crucial. So breaker blocks tends to be more reliable when large market participants are active. So that will be maybe during the London kill zones or maybe the New York kill zones. So in terms of volume, you need to understand that increased volume at the breaker blocks adds credibility to the level, suggesting institutional interest and making the setup more reliable. So what we mean is that, for instance, if maybe probably this is because here you have the BOS, so this is where we have the order block, right? So we want the price to come and break below this bullish order block so that it can become bearish, so that it can become a bearish breaker block, right? So when it is breaking here, sometimes we want to look at the volume around this particular level, right? And also when it retraces here again, we want to look at the volume at this particular point. So which will help in terms of increasing the momentum, right? Which will help in terms of increasing the trade's momentum, right? So then the other thing that you might want to consider, you need to manage the trades effectively, like I've always said. So trail your stops. So if the trade moves significantly in your favor, trail your stop loss to lock in profits. For instance, move the stop loss to break even once the price has moved a safe distance from your entry. Then take partial profits. So consider taking partial profits at intermediate levels, such as maybe the next key supports and resistance or the Fibonacci retracement levels. Then you also need to reevaluate if the structure breaks. So if the price breaks back through the breaker block in the opposite direction, then you need to reevaluate the setup. Don't be static. The market is not static. The markets are always dynamic. They are always moving, and market condition can change abruptly, right? Depending with the prevailing maybe economic conditions. So, or maybe even the time of the trading, right? The sessions that we have discussed about. So when we have such kind of a scenario, this will indicate maybe the breaker block has failed, right? Because not all the time that these breaker blocks will work, not only the breaker blocks, not all the times that the market is going to hit your TPs or it is going to go in your direction. The reason why risk management is very, very important. So the key thing now when you're trading these breaker blocks, and not only breaker blocks, but whichever strategy you're using, it is good to review and learn from each trade. So journal each setup or you document each trade. So record where the breaker block formed, what confirmation signals you used, and how the trade played out. This is very important because when you come to analyzing and the winning and losing trades, look for patterns in successful setups that, for instance, confluence factors, entry signals, all right? So that will help you now understand the strength, all right, or the key points that are making you to take the trades, all right? So for the successful trades, you'll see what you're doing, or there'll be a pattern that will be repeating itself, what you're doing, for you to be able to understand those winning trades. And also, when you're analyzing the losing trades, it will also help you in terms of knowing the mistakes that you are making and the reason why you are incurring losses, and therefore you'll be able to minimize those mistakes. So then it is always good to adjust your strategy. So use your analysis of the winning and losing trades to refine your strategy, focusing on factors that increase your success rate, right? So let me take you to the chart so that I can show you a few examples of how to identify the breaker block. So let's go to the charts. So welcome to the charts, and let's begin by looking at different examples. All right, so this is gold. This is gold. So this gold is I'm looking at it from the 4-hour time frame. All right, I'm looking at it from the 4-hour time frame. So let's see what we have. All right, so when you look at this particular goal that we're talking about, so at this particular point, all right, this particular level here, we see the market making series of in a downtrend. All right, we see the market in a downtrend. Okay, so this is a previous swing high. This is a swing low. So at this swing high, what we have also, we have the price creator BOS, right? We have the price creator BOS here. Then at this particular level, therefore, we identify our order block. So the last sell candle, the last buy candle there, right? That's our order block, the last buy candle before the down move. And then now, what we anticipate is for the price, right? We anticipate the price to sell. The moment the price comes here, we anticipate this because this is a bearish order block. We anticipate some selling pressure here, but the price did not sell. Instead, it broke above this region, and therefore, what it did here, we have now a bullish breaker block. All right. So you wait for the price to retest, and the price came down to this particular level. It is retested there, and we had about 304 pips. So this is how your setup could have been. So it's a buy entry using a bullish breaker block. So you take a buy position like that. You have your stop loss slightly below there, below the breaker block. And if you're buying from that particular zone, of course, you are targeting the price to come to these liquidity levels. And what you can see here, this is a risk-reward ratio of 1 is to 2.66. But surprisingly, the price did not come to this level because it respected the order block. So you might use this order block here as your take profit level, all right? Or maybe if you're using the liquidity, then it was important for you, which is also correct. But what I'm trying to emphasize is the importance of taking partials and trailing your profits. So you see here, the price has reached a key level, which is a level of where we have an order block, all right? So therefore, it is important for you to take partial profit and put your stop loss at break even, because it's not a guarantee that the price will come to take out the liquidities at this particular point where you have your target. Okay, so let's look at another example. So this is another example, right? This is another example. So at this particular point, we have the price take liquidities, or we have a BMS, right? A BOS or a BMS. So therefore, what it means is that around this particular point here, we have the order block there, all right, that particular level. So that's where the price was originating from, all right? And actually the first BOS is here, all right? The first BOS is here. So that's where we have this particular order block there. So we are anticipating the price to buy from this level, but you can see the price broke below that particular point, all right? So now this bullish order block turns to be a bearish breaker block. So the moment the price comes to retest this level, we take a sell position. So, and this is how you have your sell position. So you take your sell immediately the price comes to that level, and then maybe you can target the order block around this point, or maybe you can target the liquidity level there, and then your stop loss need to be slightly above that particular point, right? And then now you can see the price comes back to that particular level, and then we see a drop, which drops to about 347 pips, right? So let's look at another example for a bullish breaker block. This is 0 USD, and for this 0 USD, as you can see, the price was in a downtrend. And then this was the last BMS that happened here, or the break of structure that happened there. Right. So here we are looking at the last sell candle, right? We are looking at the last buy candle before the down movement. So, and the last buy candle that we have is this particular level, right? This is the last buy candle we have before the price starts to move on the downside. Okay. So then from that particular level, this is when now the price is coming back to this point, we expect a drop because this is a bearish order block. So we expect a drop, but now the price only reacted slightly in this region, and then we see the price going higher. So we see the price breaking above that particular point, all right? We see the price breaking above that particular point. And then now this level or the bearish order block will turn now to be a bullish breaker block. So you can see the price coming to retest this. So this is the retracement, the price coming to retest that level. And then now you can have your setup, right? This is how you can have your long position, right? So your stop loss slightly below the level there, and then you are targeting the liquidity levels around this particular point. That's a risk to reward ratio. A trade of a risk to reward ratio of 1:2.17. Okay, so you have your nice setup and your TP is hit, right? You have a very nice setup and your TP is hit. So in summation, for you to be able to understand the bullish breaker blocks and the bearish breaker block, so there are two things that you need to look at, right? There are three conditions that needs to be met actually. So in an uptrend, we know the price creates lower lows and it creates higher highs and higher lows. So the moment now we see the price, right? The moment we see, because we see the price create a BOS. So at this particular point, we want to look at the last buy candle that led to this before the price started to move higher. So let's say this is where we have our last buy candle, our last sell candle before the price moving higher. So this is the point that we have a bullish order block. So remember the first condition, there has to be a BMS or liquidity sweeps or run on liquidity, as you can see here. Then now, once we see that, we come below here and look at the last sell candle before this price move that went to create a BMS or a BOS or a sweep of liquidity. And this becomes the bullish order block. So we anticipate literally, we anticipate the price, right? Literally, we anticipate the price to come to this level, and then now we anticipate a sell. But sometimes that will not happen. We'll see the price, we anticipate a buy. So the price will come down to this level and we buy because that's how we trade a bullish order block. But now when we have a break through that level, right? When we have a break through that level, what we want to see is the price retest that level. And then now we look for our sell entries, all right? We look for our sell entries. So this now, the bullish order block turns to be a bearish breaker block, right? It turns to be a bearish breaker block. And this is how you'll have your entry, right? This is how you'll have your sell entry. As simple as that. In the other condition, when we have market in a downtrend, so it's creating the BMSs on the downside, or it's taking the liquidities on the lower direction. So the first thing we want to see BOS, or a sweep on liquidity or run on liquidity. Then we look in this retracement, we want to see the last buy candle before the sell momentum. And that is where we will have our bearish order block, all right? That is where we will mark our bearish order block. So in real scenario, what we are looking at is for the price to come to this point, and then now once it touches the bearish order block, we look to sell, all right? We look to sell. So, but in case the price does not sell and breaks above this bearish order block, then we want to see the price retrace back to the same level, and now we want to see the price continue going higher. So this bearish order block, once it fails, it is now what it becomes a bullish breaker block. And this is how we will have our entry, all right? When the price is coming to retest there, our stop loss will be below that point. And in terms of take profits, like we said, we can target maybe probably we can use the Fibonacci extension levels. We can use the liquidity levels or the swing highs in terms of targeting your profits, or maybe the risk to reward ratio of 1:2, 1:3, whichever you feel comfortable using, but it should not be less than 1:2 risk to reward ratio. So that's how we trade. That's how we identify high probability breaker blocks, right? So there has to be a break of structure, there has to be sweep of liquidities, or maybe a BMS, and then there has to be a run on liquidities, and therefore a retracement, and then now you take a trade. But in a nutshell, in case you forget, don't forget this, that when a bullish order block is broken, it becomes a bearish breaker block. And when a bearish order block is violated or broken, it becomes a bullish breaker block, right? So that's it from me today. Let's look forward to the next video. So make sure that you like, you subscribe, you share with your friends, and the next video will be even more amazing. So until then, keep safe and talk to you later.